Do you want to start day trading but you don't know where to start? It is very important that you have a strong foundation. But what is even more important is that you have the right foundation. Otherwise, you'll waste years and probably thousands of dollars trying to figure this out without any guarantee. And I always hear three questions when I tell people that I'm a day trader. First one being, so you sit behind a chart all day? That must be very difficult. Or do you just press buy or sell? And the truth is, with the wrong knowledge, you can get stuck behind the charts all day. It will be difficult and you will feel like you're only just pressing one or the other button, because it will feel like you don't know what you're doing. So I made this video very simple, going over everything you need to kickstart your journey. We will go over mindset, using the right software, how to read the charts, what moves the market, choosing the right market, choosing/creating the right strategy. We will go over trade placement, trade management. I will answer the question, is news important? We will go over journaling and practicing. And last but not least, how to leverage your money using prop firms. So the first thing is a mindset, because this will be your biggest challenge throughout the whole trading career that you're about to dive into. And having the right mindset to start this off will be very important, because you have to understand that this is a probabilities game, and that's basically all that counts. Having the probabilities tip in your favor and not in the favor from the markets. Now, how you do this? You can do this through various strategies, but to know that this is the only aim of the game and not focusing on winning or losing will be one of the most important things that you need in the beginning. And on my table I have a lot of poker chips, and the reasoning for that I will explain in another video. But basically what traders think, or what people think when they hear about a trader, is that you just gamble, right? You gamble away your money and you just hope some trades stick and some trades win, and that's how you make your money. Now if you dive deeper into this, you know that a poker player and a trader have a lot in common, as if you're good enough, there is strategy behind it. Now the very big difference between an average guy that goes to the casino and an experienced poker player is that the experienced poker player makes all the money and the average guy loses everything. And some big reasons behind this is that the skilled poker player, of course, has the skill, but he also is very good at risk management. He knows when to capitalize and he knows when to sit on the sidelines. And it's exactly like that with trading. Because in the end, let's say you're playing roulette and you only have one chip. You would say that your best bet, the safest bet that you can make, is putting it on red or on black. You have a 50% chance. If you put it on any of the numbers, your chance decreases by a lot, right? So your best chance is putting it on black or on red. And if you have a lot of chips, you can try this a lot of times. So we would say that theoretically, half of these chips would be a win and half of these chips would be a loss if you always take the same one, if you always take black or if you always take red. And the casino, it won't make you that much, because putting it on black or red on the roulette is just giving you a 1/1. You put $100 in, you get $200 back. So if you then lose the next gamble, you're still at break even. And the thing is with trading is that we have this edge, right? And our goal is to, in one way or the other, tip the scale so that we make more than this. Because otherwise we could just be going to the casino and put it all on black or all on red. So we try to make more than this. And how we do this is by, having a higher win rate than 50% if you're trading a 1/1 system like the roulette, or working with a bigger risk to reward. So for every $100 you put in, that you get 300, 400 out of there. So with roulette, you put $100 in, you get $200 out, your original bet plus $100. And with trading, if you trade a 1/3, for example, you get a $300 out, but you don't put the $100 in. If you're not losing, you're not losing that capital either, right? So very important that you focus on, we're not gambling, we are focusing on probabilities and we're tipping the scale in our favor. But it's also very important that you focus on what you can control, not what you can't control, right? So if the market flies away without you, you cannot control this. If it suddenly flies through your stop loss, you cannot control this. But what you can control is focusing on your risk management, focusing on executing your strategy as good as possible. And by doing this, you will make sure that you're tipping the scales in your favor. And basically the number one way to improve your behavior on the charts, if it is for discipline, confidence, fear, whatever it is to improve this anywhere else but there. And this is like a major cheat code, a major life hack. But if you want to become a better trader, you have to become a better person first. And I also say this to my students, they start going to the gym, they delete social media, etc. And they see their output in trading probably go 10 times just because of those tweaks in the real life situation. Now, using the right software is probably one of the biggest building blocks that you can have. And as a complete beginner, I can imagine that you don't know where to start. So real easy. For charting, you use TradingView. Probably 95% of the traders use TradingView for their charting. For practicing, you use FX Replay. You can use other programs as well, but I personally like FX Replay the best. They have the best data, so that's why I'm recommending them to you. For journaling, you can use Edgewonk, TradeZilla, Notion, or simply just Excel sheets. And for executing, you can use MetaTrader, NinjaTrader, CTrader, Tradeovate. You just have to see what you like and also what your broker offers you. Not all brokers and prop firms work with the same platforms, so you have to see for yourself which ones they offer and what works. Now, what is very important is that I listed these things on here because they matter. Charting matters, obviously, but practicing matters as much as charting. Journaling matters as much as charting, and obviously executing as well. So make sure that you go through these and choose what you like, but make sure that you have one in every category that you're ready to start with. There are links for all of them in the description, by the way. Now, how to read the chart. And this one is very important because this will be a crucial stone in your career, in your market analysis skills. And what I see a lot of beginner traders do is they put a lot of lines on there because they learn a lot of things, right? They learn, for example, what a previous low is. They learn what maybe a fair value gap is. Maybe they learn what an order block is, etc. And they mark literally everything out on every time frame. So if this is a 3-minute, they would also do this on the 5, on the 15, on the 1 hour, on the 4 hour. And it can get messy very, very quickly this way. So what is very important, at least this is what I like, is to keep your charts as clean as possible. Look for and really ask yourself, okay, what are the areas that are actually useful to me? Is it useful to me to mark something out down here if we're still trading up here? If your narrative is that price is going to move lower, maybe into that area, and then you want to buy from there, sure, go ahead and mark this one out. But otherwise, keep it relevant. That is, I would say, a crucial key element in your charting analysis is keep it relevant. That is the most important cornerstone that you can have. Keep your charts clean. Make it in a way that it is easy to read and it does not influence your emotions. As you can see, I have my bars in black and gray. The standard will be red and green. Now, red and green are very vibrant colors. And when a color is very vibrant, it can influence your emotions a lot quicker. So a very good tip right there is color your chart in a way that it will not influence your emotions that much. Every small thing that we can do, every small adjustment that we can make that will benefit us, we should do that. You can also do it black and white, black and gray, like I have. Maybe black and a color that is a bit more vibrant, but I would say keep it as neutral as possible. Some people like to do black and black, right? So that there is no difference between them. Now, I do like to see a difference between them as I find it easier to see, okay, is this one bullish or is this one bearish, especially if it matters and I don't have a lot of time to make that decision. And by the way, if you see other YouTubers use purple and yellow or whatever it is, that's fine. But believe me, the less vibrant the colors are, the less emotions and the less dopamine it will spike out of you. Now, how to actually read the charts will depend on your strategy because some people are reading it according to trend lines. A trend line, by the way, is a line that is showing you the trend, right? Some people are maybe reading it off order blocks. So we will come back to that in a second when I'm talking about choosing or creating the right strategy. So the next one is what moves the markets. And there are a lot of philosophies, I would say, about this topic and a lot of heated arguments about this topic, what moves the markets. But actually it is just buying and selling. And to know what causes a buy or sell, we could maybe narrow this down to supply and demand. Because if you look at it, everything that you know about trading, it will always narrow down to supply and demand. That is literally what trading is about, right? If there is too much supply, the price will go down. If there is too much demand, the price will go up. It is this never-ending scaling game. How do you know if a currency has too much supply? And how do you know if a currency has too much demand? The currency itself or the asset itself that you're trading will not particularly give too much supply or too much demand, but a certain price point will. And to make this easier, let's use an analogy. So let's say you have 50 apples and you're currently selling them for $1 each. So for this $1 each, 20 people want to buy it, right? Maybe a bit overpriced for one apple. So 20 people want to buy it. Now, your neighbor, your selling neighbor, is selling them for 50 cents each. Now all of a sudden, 70 people want to buy it at this price point. Okay. Now, both of them have an issue. The first one being there is a demand issue at this price for what he is selling. And the second one being, there is a supply issue at this price for what he is selling. Because person 1 has too many apples, he will have 30 left over. Let's say everyone is just buying 1 apple. And person 2 doesn't have enough apples. So a thing that the first one can do is lower its price. Because by lowering its price, it will attract more people. The thing that the second one can do is upping its price or upping its supply. But let's say it is not possible to up the supply. Then the next thing that you can do is up your price. And what you then will see is that you will probably meet in the middle. In this example then, they will meet in the middle at $0.75. At this point, you will have 50 people that want to buy. So you're in a perfect equilibrium. We can even do it like this. This is the perfect equilibrium, and this is the chart. Perfect equilibrium is right here. This person is somewhere down here because he has a high demand but a low price problem. This person is somewhere up here because he has a high supply and a high price point but a low demand. So when they meet in the middle, they will find the most optimal gains. And that's how it works in the charts. What moves the markets are people with a lot of apples, right? Because they control the supply. And basically they control what the market moves. Now, this is not one company, not one bank, not one instance. Now, to simplify this in the markets is that a supply zone is a place where enough people want to sell and not as much people want to buy. And the demand zone is where enough people want to buy and not as much people want to sell. So what could we see? These are basically the areas where price rises and drops, right? You have your supply zone and you have your demand zone. Now, this is a whole strategy, supply and demand. And this is actually deep down what moves the market. But still, there are a lot of strategies built off supply and demand. Me, for example, I go a step deeper. I look at what price is doing, where the orders could be laying at, and I try to trade off that. Because, for example, I see right here, we create an equal high. And this is, by the way, today's price action. I see right here, we took out liquidity from this previous low. And I mentioned liquidity. Liquidity is something that is very important in the markets because liquidity means this is where the money is being bought and sold. And what you will see in trading is that everyone learns that it is safe to put your stop loss. So a stop loss is basically you get out of the markets at this point underneath a previous low if you're going to the upside. And for example, you target, let's say a 1/2 risk to reward, okay? Something like this. So for every dollar that you risk, you get 2 back in return. Now, what the market often does is if it fails to break that previous high, it's going to seek more liquidity, meaning that everyone that got in right here is going to get liquidated so that there is more money in the markets to buy a new position, right? So the smarter traders, they're basically buying all of these stop orders right here. So the ones that got stopped out right here are being bought by traders down here. Now, this is a bit more technical and, to be honest, too much to be discussing in this video. So I will leave it at that. But I have enough videos about this, about liquidity. And it is a really, really interesting topic. And I will make more in-depth videos about this as well. Also for beginners so that you know exactly where to start. But for now, let's just keep it simple because that was my promise. And we move on to the next one. This is choosing the right markets. And I see a lot of people, they choose the markets they trade based on the people that they follow online. And my advice is that please don't do this because you're basically determining your career on someone you follow online. It doesn't really make sense, right? Now, if it is your teacher, if it is your mentor, then for sure, go ahead and trade the same thing that he or she does. But if this is not the case, then do your own research, do your own backtesting and collect your own data and see what works for you. Because some people, for example, they are very good at trading gold, very good at trading yen pairs. And something that you must know about these two examples that I just give is that they're very volatile. So they move quite a lot in a day. Now, you could think, okay, then I can make a lot more. But this is not really how it works. You can make a lot more, but you can also lose a lot more. To be able to work with moves like that, your psychology needs to be in a very good place as well. So I always recommend to start off with major pairs. And major pairs are basically every pair that includes the US dollar in it. So a Euro USD, a GP USD, an NZD USD. Pairs like these, they move a lot slower, but still you can make amazing trades with them. And I have to say the last few weeks, the major pairs have also been moving quite a lot just because of the market conditions that we're in at the moment. But this is that model that I just talked about, is that price was not able to break these highs and is now aiming for these lows, right? And perhaps afterwards they shoot up higher. So choosing the right market is very important, but collect your own data. This is really how you should approach this. Now, choosing or creating the right strategy. Again, something that you can't determine based on who you're following. In order to choose the right strategy, in order to create the right strategy, you have to do a lot of backtesting and you have to make a lot of rules. So I see a lot of people, they see a strategy online and they just go to the charts and they try to implement it how they saw it on the video without taking notes, without noting the rules down. So they're just basically winging it. And it is very important to note a strategy down to the T. So literally every single step that you're doing inside of the strategy, note this down, especially as a beginner. Now, I personally don't really trade a mechanical, so to say, strategy anymore, as I have a lot of experience in the market. So I'm able to tweak my entry at everything that I see in the markets. But for a beginner, this can be very, very difficult as you don't know what you're seeing. Remember, I have 8 years of charting time behind me. So look at the strategies that you see on YouTube. I would say really do your research well and also really think about who you're following. That is very important, right? Because some people are just making strategies for content. Okay, just see what works, but don't believe that it works. Do your own research and collect your own data. You do this by backtesting it on FX Replay, and don't go for anything less than a sample size of 50 to 100 trades. Okay, I want you to backtest this in a real life situation or as close as real life as possible. Meaning that if you are trading between 9 and 10 a.m. in the morning, and this is the only time that you have available due to work or whatever it is, also replicate this on backtesting. It doesn't make sense that you're going to take trades at 3 p.m. in the afternoon if you're always at work at that moment and you can never trade those trades anyway. So collect your own data and see if it works for you. I also want you to backtest by noting everything down, taking screenshots of every trade, because this will be a crucial step in your learning process. And it will be very difficult and it will require a lot of discipline, but believe me, this is the quickest way to make it work. Now, trade placement. Okay, so let's say you want to take a position, and like we discussed before, we probably want to see this one being taken out. But let's say we do see this one taken out, and depending on your strategy, you determine, can I get in or not? Now, I use this tool on TradingView, and this one is called the long position and the short position. You can find it right here on the left, right? Because this will show your projection of how much am I risking and how much is my potential to the upside. So let's say, for example, you want to take the position like this, okay? So for every dollar that we risk, we get $4 back, which is very, very good because this can pay for maybe the next loser, the loser after that, and even the loser after that. What you then do is you go to your executing app, right? This can be MetaTrader, CTrader, whatever it was that you're trading with at this moment. You can see that on this trade, on the bottom, you can see 5.0. This means that we are risking 5 pips to make 20 pips, all right? This is more like a quick in and out trade. I would say as a beginner, for sure, make sure you have it at 10, 15 pips, depending on what makes sense on your strategy as well. Now, very important right here is that you're going to implement risk management. And risk management means that you are managing the risk that you're taking. And the risk that you're taking is determined on the account that you're trading. So if you're trading, let's say you're trading a personal capital account of $10,000, all right? If you're trading 1% on every single trade, it means that you're risking $100 on every trade. So you need to calculate what lot size you need in order to take this position right here. So $100 risk on Euro USD with a stop loss of 5 pips, you will need to risk 2 lots. Now, I know this as I've been trading Euro USD for the last 5 years or so, but you can use lot size calculators for this. And it's not that difficult, right? You just go to Google, you press on lot size calculator, and the one from my FX book works great. Okay, but it is very important that you use a lot size calculator so that you know exactly what to risk, that you're never over risking or under risking, because this will break the edge of your risk management, right? Your edge is determined by your strategy times your risk management, how good you are at managing your risk. And a crucial element of risk management is that you're allocating risk in the right way. So this can always be the same, or it can be linked to a certain type of setup that you take. For example, some people, they grade their setups. So they would take an A+ setup and maybe risk 2%. And if they only take a B setup, for example, they only risk 1%. So there's also a way to approach it. Now, trade management, something very important. And trade management means what you're doing while you're in the position. So a couple of things that you can do. Let's say, for example, you're in a profit. Let's say, for example, we've taken a position like this. right? Now, if you're in a profit, you can decide to put your trade to break even. This means that you will be moving your stop loss up all the way back to where you're not risking any dollars anymore. You can do this if you're in a profit, all right? It can also mean that you're moving your stop loss even into profits and that you're basically just following the charts all the way up until it stops you out. This is called having a trailing stop. You can also decide to scale in. So for example, have opened another position, okay? But what I want you to do, especially as you're a beginner, I want you to just leave the trade alone. Couple of reasons for this. One, it is very, very likely that you're not the best risk manager, let alone the best trade manager. So you have to learn how to be a good risk manager first, how to be a good analyst first, before also managing your trades. Second one is managing your trades will mess with your emotions. So let's say, for example, I give you a scenario right here. It is running up right here, 2R, and your target is like this. It is maybe 3.5R. And price starts turning against you and you get scared, you get out. But if you just would have let it run, it would have made you all the profits that you needed. Now, doing this one time doesn't hurt you. Doing this 2 times doesn't hurt you. But if you do this 5 times, 6 times, 7 times, you see that your losses are full losses, because in drawdown you won't be able to do this, believe me. So you're losing minus 1%, and on your winners you're only making like 0.5%, 0.75%, maybe sometimes 1% if you're lucky. But like I said before, your winners have to pay for your losers, and you're not doing that at this moment. So basically you're losing money even though your win rate is positive. So don't do that. But because of this, I would advise you to keep your risk to reward relatively small. 1/2, maybe a max of 1/3. If you're following this system, 1/2, 1/3, you know the data, you know your strategy, and you have a positive win rate, meaning that whether 1/2 it is over 40%, whether 1/3 is over 33, 35%, then you're making money, okay? But only if you're letting it go to stop loss or take profit. Now, is news important? News is super important, all right? And don't let anyone tell you otherwise. Of course, if you're trading technicals, the news from, for example, the next week or the last week won't really influence you that much. But it is very important to know that there are news events coming up later today, later this week. So for me, for example, today is Thursday, the 3rd of July, and today is NFP. Normally NFP would be tomorrow, but tomorrow is the 4th of July, a bank holiday in the US. So this means that I'm not taking any positions today because tomorrow is the 4th of July and today it is going to be NFP. NFP, by the way, is non-farm payrolls, one of the most important news events in the month. Now what you can do, and I would really advise you to do this, because remember, you want to be a trader. So please take this as serious as possible and do your best to learn everything about the craft. So you can go to Forex Factory. It's like a news site that lists every single news event that has influences on your currencies that you're trading. You can filter this for all the currencies that you want to see or you don't want to see, okay? Red folder news is the most important one. Orange is like medium important. Then you have yellow and gray. Gray are bank holidays, okay? And you can basically choose what you'd see, but you can also choose what you learn. So what I would advise you to go is go over all of the coming weeks and just see all of the red folders, all of the orange folders, and do your research on them. Learn about them. Learn what it means if you have a negative non-farm employment change. Learn what it means if you have a positive CPI, for example, right? And by implementing this, you can also see what the market is going to do. But most of the time, it will be already priced into the markets before you get the news event, because 90% of the bankers, they know what the outcome is going to be of this news event. That's why it's already priced in. But sometimes they could be wrong, right? And then you see a massive push or a massive sell-off on a given currency. Now, you still have black swan events. What are black swan events? Black swan events are events that happen very, very sudden. Think about a war, think about a flu outbreak, things that you cannot really foresee and that happen very, very sudden. Now, journaling and practicing. Journaling and practicing is most probably one of the most important things that you can do as a beginner and as a trader in itself, because this is basically just keeping your diary and making sure that everything is working out how it is supposed to be, that you're taking the trades that you're supposed to take and that you're doing the work that you're supposed to do. Because if you're not keeping a journal, you can start going off rails very, very quickly. And there's a famous saying that I will always remember. Can't really remember who it was from, but it goes, you will forget your setups, but your journal won't, right? And this means that if you make, for example, a mistake on Monday, you've probably forgotten about it 2 weeks after, right? Some people even by Friday, meaning that you will make that mistake again. But if you go over your journal, you see this mistake not once, but you see it maybe twice, 3 times, 4 times, 5 times. If you're doing your work well, you see it 50 times, okay? You see this over and over and over again, but also your winners. Meaning that you are starting to work a lot more towards that winning behavior instead of that losing behavior. Now, practicing, like I said before, backtesting is very, very important, and get a good backtesting tool for this, where you can collect data, you can collect screenshots, and you can basically practice the best and easiest way possible, right? Removing friction from studying, from backtesting, from journaling is very, very important. And having the right apps in place will really, really help you with this. Now, let's say you're trading and you're making some money. You're making some money on demo, maybe even on the personal accounts. I would advise you to go in demo, then go on personal accounts, before you go to the next step. And that is leverage your money by using prop firms. So what are prop firms? Prop firms are basically companies that provide you capital. This is simulated capital, by the way, that you have to prove yourself with first. So you have 2 evaluations. The first one is you have to make 10 or 8% and you can only lose 10%. And the second one is you have to make 5% and still only lose that 10%. If you're trading the futures markets, the prop firms work a little bit different. You have to make 6 just one time and you can only lose 6 just one time. But that 6 that you can lose, it always creeps up on your winners as well. Let's say you started 100K and you can only lose 6 grand, meaning that you could go to 94. But you take a winner and from 100K you go to 102. Now you can only go to 96, right? It is always 6% of your highest point. That's how it works. And for which one is better, you have to see what you like more. Do you just like a quick eval, but the rules are a bit more strict? Or do you want a bit more room to breathe, but it is a bit harder to pass? Obviously, it all depends the most on what market you're trading. Now, what you then can do is, instead of trading with the $500 that you would have had in your personal accounts, for $500 you can buy 100K accounts with a prop firm and you have 200 times the buying power. Okay, so with a $500 account, it is extremely